Welcome back to the Paperstac Podcast. My name is Rick Allen. I've got TJ Osterman here with us today. Really excited about what we've got going on today. We got a super interesting, different twist on investing in notes.
Yeah, business notes.
Yeah. We'd like to welcome Grant Ferguson and Nate Smith from Jumpstart to the Paperstac Podcast. They're experts in the world of business notes, which, I've been in the space a little bit. I knew about business notes. I've known that, obviously people go get loans on business notes or on businesses because not everybody has cash to go out and buy it.
Yeah.
But these guys, this is what they live and breathe and do every day. Grant, Nate, welcome to the show.
Thanks for having us, guys. Thanks. Great to be here.
Yes, absolutely. I'd love to hear a little bit about you guys. I mean, as you know, with Paperstac, what we do, we buy and sell, or we don't buy and sell. We have a platform that allows people to buy and sell debt in general. People are predominantly doing the single-family real estate debt. We have had some commercial loans go through there, starting to see some other consumer type of debt. But I'd love to hear a little bit about you guys, your background, your history, how you wound up, cradle to grave, so to speak, how you got to where you are today, how you met, all those type of things, just so we know a little bit about you, and also so do our users.
Yeah.
Yeah, that sounds great. Nate, you want to go first? I can jump in.
Yeah, absolutely. So welcome everyone. Nate Smith here. As you can maybe tell by the accent, I'm from the deep south of Australia. I came here to the good old USA, probably 18 years ago now. So this is home for me here in the wonderful Vegas. And yeah, it's funny you talk about, and we'll get into this, just business and commercial loans for businesses in general. It's going to be a fun topic to talk about today because it is so dynamic. But just a little bit about how we got here and who Jumpstart Finance is. Just a bit of background for myself, and then how we met Grant and how we partnered up. So originally we have another business partner, Ron Davison, and Ron and I were in a different business, the same space. Many years. Ron's been in this space for like 20 plus years. My background has been in a diverse range of businesses. I just love business growth in general. So I'm all about getting the business to where we want to go, not so much about the widget. I run different other businesses, but I love this space as well. So anyway, Ron and I had partnered up, and we've been running this space and working with, and we'll get into sort of the industries we work with in a moment. And then along came Grant, funny enough, and he was in the exact same space. And for whatever reason, he'd reached out to us and said, "Hey, you guys, I know we're sort of competitors, but just love to have a chat, and this will form into some of the areas we want to get into in a little bit." But yeah, just funny how we met. We just had a conversation one day and just sort of liked the culture and who we were and the feel of the three of us, and kept the conversation going. And last year we had some great conversations and decided to partner up. So officially in September last year, Jumpstart Finance technically was born, and from all our years of background, and here we are today. We're stronger and bigger and better together to go after, and we'll get into the space that we work in. But that's how Jumpstart Finance was formed, and it's been awesome. So I'll let you add to that, Grant, as a bit of a background.
Thanks, Nate.
Yeah.
Yeah, that's great, Nate. And so as Nate says, Jumpstart Finance was really formed September of last year as a result of two direct competitors coming together, and it's a great way to gain market share in a competitive industry, right? And we had a lot of complementary elements of what we did. All Cap Funding, which was Nate and Ron's company, and then UFS, which is my company. So we're excited about that. It's really a growth market. And just really briefly about myself, I actually have a long history in both startup businesses, in consulting, and in the corporate world, and the rigor mortis that often goes along with it. But I've spent a lot of time at 𝗕𝘂𝘀𝗀𝗄𝗃 in lending. I've done consulting with Wells, 𝗕𝘂𝘀𝘀𝗀𝗃, and a bunch of other banks and financial services companies. But about 4 or 5 years ago, I decided I wanted to get back out and run my own business again, and get out of consulting and get out of corporate America. And so I ended up buying a business. So it's kind of funny because I went and did what now Jumpstart Finance helps people do, which is get out of the 9-to-5 and go seek autonomy and have more ownership over their career by buying a successful cash flowing business. And so that's been really an exciting ride. And the businesses operate in, as Nate has sort of alluded to, our niche is really in business acquisition lending, as well as in franchise purchases. And it's a huge growing area. You've heard of before, I'm sure, the silver tsunami or the gray wave of retiring baby boomers, and an estimated, 8 to 10 million businesses that are going to be sold in coming years, and $10 trillion of wealth transfer. So many of these business owners have built up very successful, cash flowing, profitable businesses with great products and services, with recognizable brand. And, they're ready to get out. They're ready to retire. They might not have family members. They might not have, kids that want to take over the business, or may not have kids at all. And so they're in a position where they want to, create a cash generating liquidity event for themselves. And usually the only way to do that is to sell the business. And so for a new buyer coming in, not everybody has got enough cash to go buy a business with cash or investors behind them. And so there's typically financing involved in that transaction. And there's a lot of different ways to go about buying businesses. But, we'll get into this more, I know, but the SBA 7A loan program is often the go-to, for these businesses. And like last year, I think there was about 31 billion in SBA 7A volume. I think an estimated 6 billion of that was business transfers and purchases. So, it's a pretty decent amount of volume just on the SBA side.
Wow.
So what we do with Jumpstart Finance is we provide an alternative to SBA lending. We do refer some of our clients for larger deals, but we focus very much on kind of that $50,000 to $1 million range, where most people, won't be able to cobble together enough cash, or begging or borrowing or stealing from friends and family to buy a business. And they're going to need to go get some form of financing. And that's very much what Jumpstart Finance focuses on.
That's interesting. There's a whole lot there to unpack.
Yeah.
And so I guess starting with, you guys were competitors in the space, and it was like, what are we doing? Let's, two heads are better than one. Why are we fighting each other when let's get together and go, fight the evil empire out there, so to speak.
Right.
Super smart. What do you have?
Well, when Grant has kind of reached out to us and kind of wondering how we can work together, and there's that secondary market of a lot of the business brokers that I've spoken to as we were researching this debt vertical that we're kind of going into is, this business owner might be, 70, 75 years old, and he doesn't want to hold, if he offers seller financing on the note, he doesn't want to hold that. He wants to cash out, right? So that's the problem with the seller financing model that a lot of these business brokers are saying. There's not a secondary market or a robust market for that seller to sell that on owner financing and then cash out at a later date. Right? He doesn't want to give it to his kids or what have you. So that's kind of Paperstac, and where Jumpstart and Paperstac can kind of work together is we're creating this. We already have a secondary market on the mortgage note side, but this business note side is an interesting opportunity because it does give that seller that opportunity then to cash out, whether it be a discount on the note or what have you.
I think that's a little bit, right, that's down the road. I guess from the start of this thing, when somebody goes to you said there's this transfer of wealth coming, right? So we've got the silver tsunami, you called it, right?
Right.
And I know, my parents are in their 70s, and they went corporate world, but I know that the ones that are out there, they're ready to live their golden years. They decide they want to sell their business. Are you guys helping them on the selling side of the business, or are you basically like, look, our customers are the ones who are like, look, I want to go buy this business. I need some funding. Can you help me out with the funding?
Correct.
Exactly.
Yeah, it's definitely the latter. And I know we can get into more exciting stuff for the other way, but for now, yes, and typically, as you mentioned, brokers, that's where a lot of people selling their business stuff. So they go, I want to sell my business, let's contact someone to list it. Then their job is they're going to match a buyer and a seller.
Okay.
Traditionally, the seller says, well, I want to get money for my business, just like if you sold your home, sold your car, it's like, pay me my money, right? So typically, we're working then now with the buyer that says, okay, I need to go and get money, and it's either going to come from a few areas, which is cash in the bank, some retirement money, whatever it is, which is definitely the lower of what people do. It's all about OPM, right? Everyone wants to use other people's money.
Of course.
So the majority of what they do is, okay, let's go to a bank and get money to purchase this business, whether it's, $500,000, 200,000, 800,000, whatever that number is. The seller wants their cash and the buyer's got to come along with that cash. So definitely that's right now what we're talking about is the buyer needs assistance in buying that business. And as Grant mentioned earlier, most buyers, when you think, okay, I've got to go buy a business, they go, oh, I'll go get an SBA loan.
Yeah.
And of course, SBA is a great vehicle for a lot of people. We have a parallel to that, which is, pastors in Jumpstart Finance to come to us and say, what's the best vehicle for me to buy a business that may not be an SBA loan because of just all the things that comes with as an SBA loan, right?
Sure.
But we're here to help them now navigate. First and foremost is let's find the vehicle to buy that business.
Okay.
Now that vehicle could be multiple things that we can offer, and of course that's where some of our secret sauce comes in is, do we need to go and get some loans from some traditional banks, or do we need, we'll delve into this as one of the programs we offer, which is our actual direct lending model, which is based on your buying power, because every individual needs to have criteria for buying power, right? Because they don't already have the business, they don't own the business yet, right? So we have to use their personal
experience,
buying power, cloud, things related to credit support, just have collateral. There's a whole bunch of things we can get into. But at a high level, they're going to have something saying, okay, I want to go and get 300,000. I want to buy this business, and that's what we're here to help with. So so to answer your question on, we work with the buyer there with either brokers or in the franchise space. Of course, it's same but a little different because it is a startup, but it's in a franchise world, which has, when we help the buyer look at their clout and buying power, we're also looking at the franchise because it has history, it has success stories.
Yeah, it's tried and true, right? I would imagine when you're buying one of these businesses or when you're lending on one of these businesses, if I'm lending on it, like I've got to qualify not just the borrower, but I've got to qualify the business. Does it make sense, right? How are if I'm buying a mom and pop shop that's like a, hardware store or a pizza joint or whatever it is, it's like I'm installing blinds for somebody. I'm sure there's all different kinds of businesses, but I want to know, like, hey, look, how did they run their business as the person selling it? How are their books? Are we talking Excel spreadsheets or are we talking like, no, there's a financial accounting system in place. There's checks, there's balances. What's the operations look like? Is it just hey, send me a text when you want me to go over to this house, or their work orders, stuff like that? I imagine there's just more to it than, hey, this guy's got a good credit score, he's got some money to put down. Like, there's got to be, like, is there a path to success?
Yeah, that's a good point.
Yeah. It's funny you mentioned that, and just to use the parallel or analogy of what a lot of people understand is when you go to buy a house, there's a couple of steps involved, and it's usually the agent will say, let's go look for a house for you and what's your budget, but what's usually the first thing they say? What are you approved up?
Yeah, what's your pre-qualified? Right. Yep. What number can we expend?
Yeah.
So this leads into your point, which is often, using that analogy, they'll go to, a mortgage broker and say, based on all the information, you can afford $500,000, right? Mm-hmm. And they go to the agent with that letter and say, let's go shopping, right? So that's exactly the same in the business world. And it's funny you mentioned that. Slightly different tweak where it's a business acquisition. So we use that as an example first is, they might be working with a broker and they go, hey, I want to buy this business. It's $500,000. They start their vetting process, of course, but in parallel to that, they say, how am I going to buy it? So we often will work with them on, hey, yes, you've got the borrowing power. Let's stop there. Keep vetting the business now, to your point. Mm-hmm. You're going to look at tax returns, the business itself, financials, what the business is, what their history is, that they've been in that space. There's definitely that process of vetting and the business acquisition. The seller's doing the same too, remember? So the seller wants to leave the business in good hands. So they're also vetting buyers, right?
Sure.
So that's all part of that process. And then, of course, once they've been once they know their buying power and they can buy the business and they've done all that due diligence, and then obviously help them in the next step.
Yep.
And it's sort of the same with buying a franchise, which is, even though it's a startup, we vet the franchise.
Mm-hmm.
We have to look at all their buying power, right, in the franchise.
So a few more steps.
The history.
Then
A little bit, but it's a lot like it's like the note space. Like
Right.
every note has it's telling a story,
Yep.
and you gotta put the pieces of the puzzle together.
yeah.
What's the payment history look like? What's the servicing notes? Is it performing? Is it non-performing? Was it originated properly? Are all the documents in check? I would imagine it's the same. I would and kind of I think Grant was about to chime in on this, but I would imagine the franchise space. You know, obviously I don't need to vet Chick-fil-A. They've got Chick-fil-A's.
Yeah.
They've got them everywhere. They've got, or McDonald's, you know,
That vetting
the
is
fry
done up
machine
front.
goes
Sure,
there, this
sure.
goes there, it's a lot easier. Maybe you get something that's a little bit newer, there's some more vetting that goes involved, but I would imagine, the nationwide brands, it's more of a, hey, it's a plug and play kind of thing.
Yeah, when we think about direct lending, which is really relevant to business notes and buying them on the secondary market and buying them on Paperstac, we think about two things, the jockey and the horse, right? So
Sure.
really, we want to find, like with a startup, we want to make sure the horse is a Chick-fil-A or I'm going to torture that metaphor. The horse has made it around the track and other people have successfully ridden the horse and the horse has won a few races.
Sure.
But we're really going to be looking at the jockey and, their financial credibility and creditworthiness and what they have to bring to the table. In a business acquisition, we're with a startup, like a franchise, we're looking a little bit more through the windshield, and with an acquisition, we're looking more in the rearview mirror. So we're looking at the performance of that business over time. We're able to see financials, we're able to see tax returns, we're able to look at cash flow. And so there's really a couple ways of thinking about underwriting alone. One is cash flow based underwriting or debt service coverage ratio underwriting, where you're looking at the business fundamentally to repay the loan and then the jockey to run that business successfully. Or there's DTI based credit score based underwriting, where you're looking at the jockey to repay the loan and then you're hoping that the horse doesn't crash or run off into a field and eventually is going to help contribute to winning the race, right? And so with franchises, it's a little bit more heavily leaning on the creditworthiness of the individual or the partners. And then with business acquisitions, it's very heavily leans on the cash flow of the business to support that, right? But as we all know, if something goes wrong or the horse goes off the track, you're betting on the jockey to bring the horse back on again. So that's always the fundamental, most important element is who's running this thing, what's their background, what's their financial strength, and what's the likelihood that they're going to be successful.
So once you guys, you've identified, so somebody comes to you, they say, look, we've identified a business we want to buy. We're just going to use, it's a mom and pop or a baby boomer's retiring. They don't have kids. They want to sell their business. You find out that hey, it's a good business. They did a great job of keeping their books. The borrower is creditworthy. We're going to go ahead and do that. So you guys then, you agree to write the loan. Like what kind of paperwork is the borrower signing? Are they signing personal guarantees? I've heard things like UCC filings, like kind of, we don't have to go way down in the weeds on that, but just high level, what does all that stuff mean and how, why do you guys do it?
Yeah, I can take the first stab at that, Nate. So we work, our liquidity and our lending lines are tied to a sponsor bank relationship, an FDIC regulated chartered bank. And so that makes us a little bit different from a hard money lender or private lender, that's maybe got our own underwriting and our own loan policy and our own way of doing things. Not to say that most private lenders don't do a great job, but we're held, Jumpstart, to a very, very high standard, an institutional standard of underwriting and origination, because everything has to go through FDIC regulations. So we have to do things like be compliant with anti-money laundering and KYC, KYB, which is know your customer, know your business. All of the kinds of things that go along with a bank basically rubber stamping and underwriting and rubber stamping a loan and saying, yep, we're going to board this and put this on our balance sheet, and then we're going to let you, sell it or service it and do what you want to with the loan. So we have a very high bar, which means, to your point, we're looking at, a lot of the underwriting is done in a very rigorous way where we have to gather all the right financials and tax returns. We have to do, we have to verify income and employment if it's in the case of looking more at the borrower than the business. And once we've gotten that loan approved, it has to be sort of reapproved or re-underwritten, which is not a lengthy process by our sponsor bank. And then we do, the loan docs have all got personal guarantees. In most cases, we've got 2 personal guarantors on a loan.
Wow.
There's collateral attached to most of our loans, and that can be commercial real estate or residential real estate or equipment or other forms of collateral. There's a UCC filing, Uniform Commercial Code, as you had mentioned, Rick, earlier, which is basically a blanket lien on the business and its assets and allows
So that UCC is over the whole business and all the assets that the business owns.
Exactly. And typically that would be a first position lien, so it wouldn't be behind another lender or another creditor. So, it allows us to go and attach to various, assets of a business if we need to handle it, default and collect on that loan. And then, of course, we've got other things that go along with our loans, including an escrowed couple of months of payments, which allows some safety for us to cover payments if there's any late pays. And we have loan documents that are signed and docu-signed, and so and then servicing that is done in a professional, institutional way as well. So, bottom line is we have a package that's pretty convincing to folks that might want to invest in these notes.
Rigorous.
Yeah, I think that's great because there's a consistency there, and I think we were talking earlier that buyers of notes, buyers of investments are going to run their own due diligence on it. But once I think they get comfortable with how the documents are laid out, I know when we first started buying notes, everything was different order. It was all over the place. Nothing was consistent. So it was very laborious in like how long it took to run due diligence. So I think once a buyer understands, an investor understands this is how the loan looks, it's a lot easier to run through it. Right?
Sure.
And I think that consistency and the way that you can de-risk this investment by personal guarantees. And I think I think you guys are pretty creative too on how you can actually do that, right? And that may be for a later show of really how to de-risk these even more.
Well, but also it's like, I look at this and I always tie this back into kind of mortgage note investing. Just because that's the space that I started in debt with, is like I would look at different owner finance notes, we'll say to speak. And some people it's like here's a one-page note, here's a one-page deed of trust, or they would have a deed of trust or a mortgage and reference a note that was never created. And I'm like, well, where's the note? It says there's a note. It's like, well, we don't create a note. And so, every single note was just kind of different, as opposed if I get something from Bank of America, they follow TRID guidelines. There's all these guidelines. It sounds like the stuff that you guys are underwriting and originating. It's like, look, it is extremely rigorous. It's not like you can fog a mirror and get a loan. You gotta pass a heritage test to make sure that you go back and pass everybody behind you. So I think that's awesome.
That's huge for
which it makes it, like you said, it makes it to where if you understand it, it becomes okay. Well, this is another asset class I can look at and invest in.
Right. And it's designed, it's a great points. I mean, it's designed, these loans are designed to be secondary market ready. And so, banks, as I'm sure bank-to-bank participations are very, very common. They're going on for years. It's a kind of a best-kept secret, the idea that banks are trading notes and loans between one another all the time, kind of balance their balance sheets and to deal with liquidity issues and to manage risk and so forth. But it's very largely been a bank-to-bank when it comes to business notes, participations as they're called. But it's an asset class that's not limited just to banks. Individuals, be they accredited or high net worth individuals, or even just anybody that's interested in investing in a business note can do so nowadays. And that's what's really exciting about it is so we've already sold some of our notes in our portfolio to other banks, participated into other banks. And so, again, underscoring the fact that these are rigorously underwritten and there's payment history and performance. No bank is going to buy a note that isn't performing and is going to be a high risk note to them. So, in other words, if it's good enough for a bank, it should be good enough for an investor, right? And that's what's exciting, is opening up this whole new asset class. Everybody knows about mortgage notes and the trading, and that's been a very robust secondary market. Sometimes hasn't worked so well in the MBS world back in 2008 and 9.
Sure.
But it's, everybody knows about that, but the idea that you could buy into a cash flowing business note and start getting monthly payments deposited into your checking account, is less well known, but a tremendous opportunity, we think.
Let's look a little bit at like the actual note itself, without diving like into the details of paybacks and all that stuff, but just like interest rate. Let's talk about like length, term, stuff along those lines. Like, what is it? Are we talking like, hey, whatever the par is for, SOFR plus, 10, like what are we talking about on interest rates? What are we talking about on length of the loans? Do they sell at par? Is there, should people, if they're looking to buy this, are they looking at, is there like a retained servicing? Is that common in the industry where it's like, hey, look, we're going to sell this, but we're going to, we've got our money involved. Like, just tell me about, I guess, all that stuff.
Yeah, like sweet spot. Is there a sweet spot like interest rate, or are you guys just picking it out of thin air? People are, what?
Judging by their underwriting.
Yeah, I don't.
And the banks are buying this.
Yeah, there's some sort of
a formula.
Yeah.
Talk to about that.
Yeah, some great questions. I'll throw a few in, Grant, and you can. So in this space, particularly with direct lending, people can look at low teens sort of for rates they might want to pay. We obviously stay close to the market and look at where SBA is, and obviously we have to be competitive.
Okay.
But sometimes it's all about, well, what's the advantage of your loan and what are you different? So it's that, what are you prepared to pay for it? As we know, like SBA is great, however, it has some challenges that go with it, whether it be length, red tape, for example. So we look at, hey, fast and speed, and what are you willing to pay for that, right?
Yeah.
And then, low teens right now, and then in terms of length, typical ranging between 7 to 10 years.
Okay.
Which is sort of your typical business loan space, commercial loan. Okay. And the reason for that is most people buying a business, doing the analogy with buying a home, it's all about just monthly cash flow for them.
Sure.
That's what's usually important, is can I get the maximum term, best rate possible, what's my monthly P&I, because these are all P&I loans, fully paid off and amortized over that term. That's what they're looking for. So that's important to work with them and what that looks like. So 7 to 10 years in terms of that. We can be flexible in terms of, early payouts. There are some periods they need to get into the loan first to invest in that. But typically, once they're 1 to 2 years in, if they need to go and refinance, they can go and do that. What else am I missing, Grant? Term interest.
No, that's right on. I think the servicing piece, depends very much on the buyer. When you're talking about individuals that want to get into this space, typically they don't want to be servicing a loan and, setting up ACHs and sending out statements and tax documents. So we handle all of that.
You guys have internal servicing.
Yeah, exactly.
Oh, okay.
Our own servicing platform. So we can do all of that, and that makes it just a lot easier for a buyer. And also, I think even for the borrower or the individual that's repaying the loan, it gives them a comfort. We all know what it's like to have servicing transferred time and time again on our mortgages and things like that. And then every time that happens, it's a new portal and a new login, and they missed the first payment or whatever. So we just want to keep it consistent and make it an easy transition for both the buyer of the note as well as the borrower. And so we handle that, and we have a very reasonable fee that we would charge for that to just handle all of it. And it even involves, if for example, borrower maybe has a late payment or, maybe missed a payment, we would follow up on that. We would, make sure that the loan stays current and so forth. And as a buyer who is looking for those payments coming into your checking account every month, you don't want to have to worry about that stuff. You don't want to have to go try to find a business owner who might be a day or two late on a loan payment. That's something the servicing group would handle, which would be us in this case.
Yeah, I was just going to ask about the loss mitigation waterfall, because that was always a big thing for you and I when we're looking at a note. We're like, well, what happens? Because you're planning for when this thing goes, if it goes default. Like, how do we manage this? How do we
always plan for the divorce?
Always plan for the divorce.
My attorney dad would say.
Right, and so I mean, as we're unpacking here, it seems like there's a lot more opportunities to talk more about and go into the weeds about those different types of things. Like, okay, if a note investor buys one of these business notes, what's it look like in default? We know how it looks like in the mortgage note space, but I think that could be something we could unpack at a later time. I
think we should do a series, a follow-up.
I think so.
On this.
This has been really interesting.
I think, there's definitely, like you said, there's more to unpack. Seems like there's a lot involved here. Sounds like it's a good investment. It sounds like it would be, an intriguing investment.
I mean, organically, we've had a lot of people reaching out to us, happen chance to just saying, do you guys buy and sell more business notes? And that's
do you guys is there anything kind of like when we dive into like plan for the divorce, is there anything that you guys are like, oof, this one's kind of a tough sector? I don't know whether it's like restaurants or marijuana business or anything, I know that, well, I don't know if the marijuana business, can they do banking yet?
I don't know.
I think it's still federally. But it's just I would imagine there's some that you're like, oh look, this is just like it's a low risk.
Yeah, like service businesses
versus over here. This is a riskier service. Do you guys have like those matrix out there that you guys are looking at when you're establishing? Does that affect interest rate?
Yeah, that is a great question. So the good news is the divorce rate is very low on these loans. And we have decades and decades of loan performance history from the SBA, the 7A. And these loans are very much akin to that business acquisition or business transfer loan. And then, as you might imagine, the default rates do vary by industry, right? They can be a little higher for restaurants or retail, and then they can be quite low for other sectors, business, commercial services, and so forth. So we look at all that. We have access to all that data. That all feeds into our underwriting.
Like MLS comps, right? You comp the business before you loan on it, and you say, "Look, I don't need to go do my research. I've got 50 years of research done right here for me. I just got to look at it and say, hey,
that's a good point.
Does this pass the smell and sniff test on the business? Do I got a good jockey? I got a good horse, a good jockey. Hey, we'll make this loan."
And you're basing it, like you're saying, there's all that legacy data that SBA 7, the SBA, right, has available to people that are researching this stuff. And if they're buying a restaurant note, there's probably data in there showing that, okay, restaurants perform at this level within this, right? I mean, is that kind of...
You're right. And then it also adds to... I think we can delve into more, which is now secured and unsecured loans.
Yes.
So, as you can probably imagine, there's people that want to buy a business, whether it's franchise or business acquisition, and they may not have any collateral, right? They just say, I want to buy the business. I'm a good candidate, myself. However, I don't have any homes or real estate or whatever it is, right? So that would be typically, as Grant mentioned when we talk about the horse jockey, that's very much betting on the jockey and going, okay, what up to a value, because there are some limits we can delve into on unsecured loans.
Interesting.
Do you guys see an influx of like international investors wanting to come in and use this as a way to start buying businesses here? And I mean, I don't know about the immigration side of stuff. Is this an option or an opportunity there?
Not so much from a loan perspective. They're doing that. They're paying cash because they probably need to.
They got to hit those.
Lending in the US, we're not going to back a jockey from another country. Just
so you guys you're basically just loaning to the locals.
Yeah.
Okay.
Yeah, but I mean, if you raise a good point, which is a lot of folks are seeing this opportunity especially with the silver tsunami that we talked about. So you see investment and capital flowing into this, not folks that necessarily want to buy and run a business themselves, but through private credit funds and just the private credit market in general, and whether it be through family offices or even private equity in some cases. There's a lot of money, and there's a lot of money out there that's going after this opportunity. So not only do we have an opportunity to say, hey, we've originated these performing loans, these notes, low default rate, great recourse if there is a default, you can buy that and get cash flow immediately, really like a fixed income, product. But also, if you're interested in getting behind this and being part of providing liquidity, providing lending lines, putting money into, we have our own private credit fund, by the way, a Jumpstart loan fund. There's an opportunity to be involved as an investor pre-origination, and then also be able to make a back-end residual payment on these notes off of in a fund or an SPV type of structure. So there's just so many opportunities. But yeah, you can be from any country, generally speaking, and do that, right?
Mm-hmm. Well, that's an interesting point. So if you're invested, you bought this note on a restaurant, and then they're operating, everything's going really good. You're an investor. They need money to buy a new oven. As you're in there, you could be that liquidity source and provide financing for that to help that business run as well. I guess is that kind of what you're talking about? There's more opportunities there as well, which makes it very entrepreneurial. Instead of just you're buying the note, that's it, set it, forget it. That's really interesting.
Wow.
You're also de-risking your own investment by saying, hey, these guys need a line of credit or they want to expand. I want to be part of that as well because it's just helping me secure the investment of the initial note that I made, right? So there is that opportunity as well, and that liquidity can come in, rather than somebody, doing like a note between two individuals or whatever, which again isn't rigorously underwritten necessarily, and it's not saleable. That can come through Jumpstart. That can be a working line of credit, or just a working capital loan. And then they can still benefit on the back end of that note as well, right? So there's a lot of ways of doing it.
Yes. If you guys are interested, I'd love to do a follow-up series
I think there's a lot. I personally have a whole bunch of questions. I think there's so many different ways that it could go, and I think our goal here is to really educate our user base and other people that are out there looking at this opportunity. And I think we threw a lot of stuff out there all over the place today, and I think we could focus in on almost like a step-by-step kind of this is.
I think so. Yeah, I think that's it. Something where we dive a little bit deeper into the let's look at the documents. Let's look at underwriting. How does that look? What if I want to buy one of these and invest in something that's been originated versus what if I want to participate and say, hey, can I give you some money and you guys use my money for origination, stuff like that.
We'd love to do that.
Awesome. Well, we'll set something up. Grant, Nate, really appreciate you guys coming on. We'll get something on the calendar. Look forward to it. And that's a wealth of information. A lot of it.
It is.
A lot of it.
Awesome. Glad we did this. Thank you guys so much for your time.
All right. We'll talk next time.
All right.
Look forward to it.
Yep.
All right, guys.
That's it for the Paperstac Podcast. Wow, great episode.
First one in a long time.
Yeah, first one in a long time. Good to have you in, TJ.
Yeah, good to be back.
Grant, Nate, thank you. We'll catch you guys on the next episode. Expect a series coming together, probably 5 to 6 episodes. It's going to cover everything we talked about and really get into the weeds and discover what are the possibilities with business notes. So we will catch you guys on the next episode. Thanks.
Sounds great.